What's up traders? In this video, we will be discussing how you can incrementally refine and develop your trading plan. So stay tuned. In order to show you guys what I'm on about, we're going to be performing a little bit of a case study here on gold from price action that we saw last week. I pulled price action back using the bar replay tool on TradingView to Wednesday, the 24th of July, 2024. And we're going to be looking at a particular scenario as it relates to my own personal trading plan. But before we dive into the actual case study, I want to highlight the main components that you ideally want to have in your trading plan. And the first one is a way in which you establish a directional bias, whether that is a short-term directional bias or a long-term directional bias. Secondly, your trading plan needs to outline how you go about selecting the POI or supply and demand zones that you're going to be looking to trade from. Third, you want to know clearly how you are going to execute a trade once you have identified your preferred POI. And when we talk about trade execution, we're talking about our entry models. How do we physically execute a buy or sell order? And then finally, your trading plan needs to outline your trade management approach. This is going to entail how much you risk per trade, when you move your stops to break even, when you take partials, and then how much percentage of your initial position do you close when taking those partials. After taking partials, you also want to outline the points at which you are going to be trailing your stops into profit. And with each of these main components, as you continue to gain experience in the markets, by executing your trading plan, by executing your trading strategy, you will then be able to pick up on little nuances of the market or little characteristics of the particular pairs that you're trading that will help you refine your overall trading plan. In this particular case study on gold, I'm going to be showing you guys how you would typically go about refining your POI selection process. So we're going to start here on the 4-hour time frame, which is the time frame that I use to help establish my directional bias for a particular trading day or a particular trading week. We can see that our 4-hour time frame is bullish because we have created a new higher high, and our major 4-hour break of structure is located here. We have an established bullish 4-hour range with our 4-hour strong low located here, as this is the starting point of the impulsive phase which generated our major break. We have our 4-hour weak high located here, which is the starting point of our 4-hour pullback, which was facilitated by our internal structure shifting from a bullish market state to a bearish market state in here. So because we are bullish, the anticipation is for price action to pull back into either the EQ or discount of our bullish 4-hour range. We would anticipate a mitigation of a well-priced POI that would facilitate the resumption of the underlying bullish trend to then target our 4-hour weak high. This means that our long-term directional bias at this point in time is bullish, and our short-term directional bias is bearish as the 4-hour pullback takes place. Now, focusing on that short-term directional bias, this 4-hour supply offers a potential counter-trend opportunity to trade down towards these well-priced POIs before we potentially see a resumption of that underlying bullish trend. And if we now drop down to our 15-minute time frame, which is the internal of our 4-hour time frame, we can see that our 15-minute structure is pointing bearish. We've recently created a new lower low. The location of our major 15-minute bearish break of structure is in here, and we have this established bearish 15-minute range. The 4-hour supply zone that I highlighted on the 4-hour time frame is this 4-hour supply here, and we can see that within that 4-hour supply, we've got a refined 1-hour supply zone. And so going into this particular trading day, which was Wednesday, the 24th of July, 2024, I was anticipating a pullback into this area before a potential resumption. Now, below that 4-hour supply zone, we've got this 15-minute supply zone that sits at our EQ. And the reason I marked out this 15-minute supply on my chart is because number one, it does sit within the impulsive phase, which generated my bearish break of structure. Number two, we can see that it sits at the EQ of our overall bearish 15-minute range. And the third main reason why I marked this POI out on my chart is because of the price delivery that we saw just below it. We can see that after this minor break of structure, we had a pullback. Price action stopped short of mitigating that POI and continued bearish. In doing so, not only did it leave behind some imbalance that price action could look to fill, but it also created this little shelf of liquidity, which would act as a potential inducement area for any sellers that were looking to get involved in this zone based off of this break of structure. Now, having identified all of the relevant POIs within my structural range, I would then go about selecting which POI I would want to trade from. And when faced with a scenario like this, I would always prefer to trade from the higher time frame POI. And the reason I would do that is because your higher time frame POIs are always going to carry just a little bit more weight than your lower time frame POIs. Secondly, as much as this 15-minute POI sat at the EQ of our bearish 15-minute range, if we look at where this 15-minute POI is located relative to our 4-hour time frame, we can see that it sits within this large imbalanced area in here. Based on my trading approach, I do not trade from imbalanced areas. And this is one of the main reasons why I focused more on looking for potential shorts from this 4-hour supply. So going into the London session of Wednesday, the 24th of July, we can see that our internal structure is currently pointing bullish as it facilitates our 15-minute pullback. And then as we allow price action to play forward, we can see that during the course of that London session and going into our New York session, price action continues to trade higher. We get another bullish internal break of structure here, and price action then taps into this 15-minute supply. Now, at this point in time, I'm very much still looking to trade from this area. I am aware that we are likely to see a reaction from this 50-minute supply zone. But again, because of the fact that it sits within that large 4-hour imbalance, I'm not looking to trade from it, and I'm only anticipating a potential short-term reaction. And then as we play price action forward, we do see a bearish reaction out of that supply, but it isn't a short-term bearish reaction. Instead, it is a bearish reaction that evolves into our bearish 15-minute continuation that ultimately goes ahead to violate our 15-minute week low, which would have been the overall objective of this bearish 15-minute range. We see that the point at which our internal structure shifts from bullish to bearish is this point here. And at that point, our bearish continuation was likely taking place, and price action did indeed end up violating this 15-minute week low. Now, I do want to emphasize that price action will not always rally from your preferred POI, and you will be subjected to scenarios like this where you miss out on a trade and price action ends up doing exactly what you were anticipating it to do. But when those instances occur, one very simple thing that you can do is to come back and investigate what exactly happened. So in this scenario, we identified our 15-minute supply zone, which means that our rule set for identifying a POI is solid, it's sound. We want to instead focus on the area in which that POI originated from, and we want to see whether or not there might be something that we're potentially missing that we could add into our trading plan as it relates to POI selection and the POIs that we're looking to trade from. The first very obvious thing that we already mentioned is that 15-minute supply sits within this 4-hour imbalance. Now, with my own personal trading plan, I don't look to trade from imbalance zones directly. I instead use imbalances as a positive confluence to add to the significance of a particular supply or demand zone. And so even though on this occasion I have seen price action trading lower as anticipated, my own forward testing and back testing has shown that it is best suited to use as a positive confluence as opposed to using it as an area where a trade can be executed. So based on that, I can kind of put a pin in the idea that this bearish run occurred because of the fact that price action came into 4-hour imbalance. Now, the second interesting thing about this area is the fact that our 50-minute supply zone formed during the Asian session. And we can see that just with a very quick eye test, this POI sits at more or less the midpoint of our Asian session range, which is denoted by this blue box in here. For those of you interested in the indicator that I use to show my session ranges, I use the FXN Asian session range here on TradingView by Rob Minty. And if we bring on our Fibonacci tool and draw it from the open to the close of our Asian session range, we can see that that 50-minute supply sits perfectly at our 50%. Another way to look at it is that that 50-minute supply zone sits between our 61.8 and our 38.2 Fibonacci retracement ratios. So now, having seen this, we could potentially attribute this bearish run to the fact that price action came in and tapped into the midpoint of our Asian session range. Remember, you're just trying to investigate potential reasons why price action traded from this area. Because as much as we know that this is something that can happen, you still want to go ahead and investigate because there could be something that you're missing. So in this scenario, price action traded from the Asian session midpoint. What you can now do is you can look at all of the Asian session ranges that followed this Asian range, and you can look to see whether or not price action has indeed respected the midpoint of those Asian session ranges. With this first Asian session range, just by performing a very quick eye test, after our Asian session range closed, we can see that price action did come into what looks like the midpoint of this Asian range, and we had a rally out of it. So the very next Asian session range did display the same characteristic that we saw in here, even though the rally occurred a lot later in this example than it did in here. The common denominator is that the midpoint of the Asian session range was respected. And if we pull on our Fibonacci tool in the same way that we did the first one, we can see that again, more or less, price action came into that range of 38.2 to 61.8 before it continued. With the second Asian session range, we can see that on this occasion, after our Asian session range closed, we didn't get a bearish resumption of price action as it came into the midpoint. However, what we can see is once we took our Asian session high, we came back in here and then we traded higher. Now, if we bring on our Fibonacci tool again, we can see that price action stopped short of tapping into those three ratios that we saw previously respected here and here. Now, a very quick conclusion that you can draw based off of this finding here is that if price action is to respect the midpoint of the Asian session range, ideally you want to be seeing a POI that formed during the Asian session itself. So we have a POI in there, and then it would seem that we also have a valid POI in there, both of which formed within the Asian session range. On this third occasion, the POI that price action ended up trading from did not form within the Asian session range because our Asian session had already closed at that point in time. And then looking at this final Asian session range before price action tapped into 50-minute supply, we can again see that after the close of our Asian session range, because price action was now trending bullish, we see price action coming into what appears to be the midpoint of the Asian session range before rallying higher. And if we bring on our Fibonacci tool, we can see that price action again, like it did on this occasion and like it did on this occasion, it came in and it traded into the range of 38.2 to 61.8 before rallying higher. Now, did this price action trade from a valid 15-minute POI? Based off of the price action here, it looks like the 15-minute POI is probably sitting at the extreme of our Asian range. and price action stopped short of tapping into that POI. And so a very quick conclusion that you can draw based off of that is that you don't necessarily need a POI in order for the midpoint to be respected. And now what I have done by very quickly looking at the 3 Asian session ranges that followed this Asian session range, where price action ended up continuing with our bearish continuation, I've now been able to spot that price action appears to be respecting the Asian session midpoint quite often. It's obviously a very small sample size, but it has occurred enough times within that small sample size to warrant further investigation. And so now, utilizing this information, you can go back and you can start backtesting all of the Asian session ranges here on gold to see how often the midpoint is respected. And so as you do that, you can start developing a rule set regarding the Asian session midpoint that you can potentially bring into your current existing trading plan to help you with your POI selection. Now, I do hope that you guys found this video helpful. Again, for reference, I pulled price action back to Wednesday, the 24th of July, 2024 here on gold. So definitely feel free to revisit this price action for yourself to do your own testing. If you did find this video helpful, do leave it a like, subscribe to the channel so you don't miss out on any future content. And as always, I appreciate you guys so much for watching.